Bloomberg News.
Now, in 1987, he told clients to sell stocks just 2 weeks ahead of the crash. And on this very show in October of 2007, he said that stocks were bound for another severe drop. But now, Robert Prechter, the CEO of Elliott Wave International, he's advised clients to close their short positions. Bob Prechter, welcome back.
Well, thanks for having me back, and it's been fun sort of sharing this whole period with you. It's been one of the most exciting periods in stock market history.
Well, what happens next in stock market history? Let's talk about stock market future. What's next, Bob?
Well, part of the reason that I suggested subscribers cover at Monday's close was, number one, the market had gone down a long way. 800 points is an awful lot of S&P points. I really knew, or felt very strongly at least, that at minimum the S&P had to break the 2002 low, and in the last few months it had to break the November low. We got both of those on Monday. We also got a reading of only 3% of all traders bullish from the daily sentiment indicators. We had, 96 to 98% bulls at the high, so there were plenty of believers back in 2007. A lot of people have given up on the market, and I really don't like to be in crowds. But I do want to stress that even though the S&P is at its lowest level in 12 years, along with the Dow, this is not a market call. Either we'll need to finish the wave structure on the downside or get enough rally to decide it's time to be bearish again. But I felt the main thing was this was strategic. It's time to take some money off the table when the market's that friendly to you. And now we're just sitting back and watching. I still think probably there's a little bit more downside to go. It's certainly not the end of the bear market by any means. But we do have a lot of believers suddenly on the downside. It's getting a little crowded.
So, Bob, this is not necessarily a bullish call. This is more about whether you should be greedy in your profit taking.
Yeah, that's exactly right. It's definitely not a bullish call. We're certainly not buying any stocks. They're still extremely overvalued by every measure, whether you look at dividends, earnings, book value, you name it. The bear market has a long way to go, as you know from the forecasts I'm making. I think there are at least 2 more years to go. We're thinking there's a possibility that it will find a short-term low somewhere here in the first quarter. But there's still plenty of risk, and so I think it was still a mistake to be buying them. Now, if you're a nimble trader, that's a different story, but investors should stay safe. We've been hammering that since we've been talking. Safety is a big key, and that's where people should stay.
Bob, tell us a little bit about the relationship between bonds and gold. What's that telling you right now about everybody's fear factor?
Well, this is one of the market calls I did make in that issue. It's a very interesting history. Most people, of course, say, well, gold goes up during inflationary times when there's a big boom going on and inflation is raging, and bonds always get hurt in those environments, so they tend to be countercyclical. Well, what's been happening in the last 10 years is exactly the opposite. They've essentially been moving up together, not always month by month, but if you look at that 10-year history, they've been moving up together. Well, in December, on the 18th, bonds peaked at that time, and the daily sentiment index showed 99% of traders bullish. We've never seen a number higher than that. And that was the peak. 2 days later, bonds topped out. Well, now we've got a very similar situation in the precious metals. We've got 96% bulls in gold, 95% for 9 straight trading days in silver, and both of them are coming up into an area where we're calling for the retracement to end. So
right,
just
Bob
as people
Prechter, we're not
are
going to
getting
end
onto this train,
we're not going to end our conversation.
We're
just going to take a break. Still with us, Robert Prechter, the CEO of Elliott Wave International, joining us from Atlanta. Now, he believes that we've reached a top in gold and treasury prices. Bob, give us a little bit more detail. Does this mean people should sell?
Well, one of the things I like to do on your show, because we do have a little bit of time, is talk about things that other people aren't talking about. So, today they're talking about all kinds of subjects relating to the stock market, but there are not many people talking about treasury bonds, not many people talking about gold and silver. And one of the reasons is, at least as far as I can see, is they're very complacent about it. Okay, everybody's got their gold positions, and now they're waiting to get rich on it because, there's so much inflation promised by the Fed and all that sort of thing. But we like to look at it technically, and what I see here is a rather crowded crowded theater over in the precious metal area. And, you know, I'm a philosophical gold bug, so it's rather tough for me sometimes to go against that. But if we can look at another chart I brought, we have a picture of gold, which has this very odd habit of turning, sometimes tops, sometimes bottoms, in the first quarter of the year. And that's not the kind of thing you would bank money on per se. But if you're in that time window, which we are now, and you get a very extreme reading on the sentiment figures, you can put two and two together and say, you know, we should keep our eyes open here. People are very excited about it. We've mentioned earlier, 96% bulls in the gold market. We also, 2 days ago, we had a slight new high in silver, not confirmed by gold. Sometimes that happens at short-term peaks. So with gold at 1,000 and silver up at 1460, I believe the peak was, just shy of that on Monday and Tuesday morning, this looks like a time we've met our retracement. I have another graph I'd like to show of silver, if we could look at that for just a second.
Well, silver certainly looks as though it's hitting a floor.
Well, it could be hitting a little resistance here, and of course, I guess you remember. I think it was last March, March of '08, when we got together and said silver's probably just made a major top. And if you know the wave principle, we've got a clear 5 waves down, and that defines the trend as bearish, the big trend. But once you complete the 5 waves, which we did several months ago, it's time for a rebound. We've got the target zone, the normal target zone. Sometimes it undershoots or overshoots between $14 and $15 an ounce for silver. Well, we got right in the middle of that on Monday and Tuesday, again with a lot of positive sentiment. So we put all these factors together, and from an Elliott wave point of view, a sentiment point of view, and just the fact that these are the only places people are focusing. You know, they're scared of the stock market now, you know, probably for good reason. They don't want to deal in very many commodities, so what are they focusing on? You know, the safety areas, this bonds and gold and silver, and I think they've overdone it. So I think there's going to be a setback here.
So, Bob, if people have profits in gold, profits in silver, profits in treasuries, not a bad time to take it. Is that your prognosis?
Well, yeah, but I generally don't like to give out trading or investment advice. All I try to do is call markets and give people a little suggestion of where things look, you know, attractive, where they look overdone. And these are just markets that are overdone. If you're looking for a place that's a bargain, these don't provide them. Where
are the bargains, or where indeed should people be putting their money, do you think?
Well, there aren't any bargains, unfortunately. We mentioned earlier that the stock market is still overvalued by every measure, even though the pessimism has risen substantially. So that puts us into a little bit of an uncertain mode on a short-term basis, but certainly not a bottom long-term. Commodities, some of them could bounce, but again, because we're in deflation and it's not over yet, we've got at least 2 more years to go, we're going to see lower lows across the board in stocks and commodities throughout this 2-year period. So you want to stay cautious. And, you know, we've been suggesting Treasury bills, some bills of certain very narrow list of foreign currencies, and, you know, a small position in gold because it's real money, but it's not time to commit heavily there.
Robert, what about real cash? Just keeping money in cash until things become more apparent to the investor as well as to the expert?
That's a very rare question. I think it's a great one. Not many people ask it. And the answer is I think it's very prudent to have some actual greenback cash in a nice, safe place. It doesn't, for one thing, Treasury bills are yielding 0 anyway. What's the difference? You know, it's not, you're not losing much in the way of interest in terms of something safe. And the other reason is that, you know, if we do reach a period where there's difficulty accessing accounts in banks, I don't think that'll happen, you know, next week, but somewhere in the next few years, I do believe that will happen. The prudent people will have some cash on hand so they can continue to make their transactions and live a normal life.
Tell me about
Even
your outlook for the dollar, if you can, when you apply your Elliott wave thesis to that. Are we seeing any kind of long-term changes in the way people view the dollar as an investment instrument?
Oh, definitely. I think the dollar made a very major low, and it's ironic the reason why it's rising. Most people would think, well, it's because the U.S. is getting healthier, so people love the dollar. But in this case, it's because the dollar was the most inflated currency in the world. There was more credit denominated in dollars than anything else. And that ocean of credit is imploding. This is what deflation is. And as that credit slowly disappears and gets wound down, the remaining dollars are going up. And even though the Fed is trying to counter that, I don't think they can counter it as fast as this sea of dollars can shrink. So I think the dollars that you can hold on to, some of them are difficult to hold on to. If you're in the wrong bonds, you'll lose money on those. But if you're in real cash and cash equivalents, I think all we're going to see over the next few years is rising value, be able to buy more with those dollars than you could in 05, 06, 07.
All right. I want to thank you very much, Robert Prechter, for taking the time to be with us this evening.